Hello and welcome to the Strategy Roundtable for May 22nd, 2026. I am Keith Harwood, CIO of Tradespoon here, filling in for Vlad. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and or the team at Tradespoon may have a financial interest in the securities presented and the trade ideas. All right, folks. So let's get a general sense of where this market is right now. So we've got a bit of a bullish day. Interest rates are starting to fall off. The market is not willing to get bearish. We still don't have resolution with Iran. We still don't have clarity on rate hike expectations with the Fed. But nonetheless, this market is not willing to pull back significantly. We got a dip. So far, the bulls have supported it. This is a setup where their bears have been burned so bad where it seems like they are unwilling to press lower. They're unwilling to stay with it. And the bulls have been rewarded every time they buy a rally or buy a dip. Now, this is the first time it seems in a while where buying a rally, at least in the short term, didn't really work out. Now, there was some projection of, okay, well, buying the dip then might work. And it seems to be working so far. Maybe the next dip doesn't have that same response. But for now, overall, market looks like it's willing to continue to deploy capital, even in the face of, negotiations with Iran that have hit that same stall point that seems the most important. They want to keep their uranium. They want to tax or toll the Strait of Hormuz. Those are like the two things that we said can't happen. So we're close, except for the two biggest issues. And so being close without the two biggest issues being addressed seems like this is just going to keep dragging on. But the market doesn't seem to worry about it. Semiconductors can still make profits. Companies can still make profits. They're still selling large amounts to AI companies, et cetera, as everybody builds up their tech infrastructure. The oil price hike and and potential inflation that can come with it could lead to interest rate hikes, and then that could be a problem for those companies looking to raise capital. So maybe it's a longer term issue. Maybe that's why the market's not worried about it. But at the same point, right now, there's no flight from the bull story. It's all about fighting every time we get a dip and continuing to buy. Now, this is generally, as we've been discussing a lot in the trade rooms, this is more of a probability of success market broadly with return on capital focused on a few sectors like semiconductors. Stocks and sectors that are moving can be return on capital trades. Stocks that are not moving, sectors that are not moving tend to be probability of success. If we're getting a lot of volatility within semiconductors, up or down, mostly been up, then I'm looking for big moves, and that means I can get a big return on capital with a lower probability of success. That volatility means that there is a greater probability that we get closer to 50-50 odds any given day for up or down. When stocks are very tight, very predictable, well, if it's predictable, I'm probably not going to get paid much for it. Probably going to be right. Now, is the reward worth that risk of a tail risk scenario, something changing in the pattern? That's the ultimate calculation we make with the options. If we have a tight rectangle that's just been stuck, while selling a put credit spread may not seem like a huge premium, the high probability of success can justify the trade. And if I've got very, very high probability expected moves, I can take smaller moves for larger positions and generate the return that I'm looking for, as long as I have my risks defined. Always be aware of that portfolio allocation, of course, and the sector concentration. So if I'm trading a lot of these return on capital sectors, heavily focused on semiconductors, I know I'm going to have a very correlated portfolio as well. And so being very correlated can cause incremental risks that people need to always factor in. If I've only got semiconductors in my portfolio and I need to exit, they may all go together. And I may take losses in everything. If I've got a balance of some semiconductors, some bonds, some energies, some healthcare, my portfolio is less likely to be correlated outside of a massive move for the broad market. And right now, we're not getting massive moves for the broad market, those 2-3% days, or, a year ago when we had 10%. Overall, this bullish market continues and we get dips because we get overbought. It looked like we were going to get into a potential for a pullback, but really it just set up more of a bull flag, at least for now. And so we'll look at some of the charts here and just kind of continue to evaluate this broad market behavior. Overall, I think that for the bull, and my bias is towards having more time for the bull trade, where I'm looking at longer term options or stock. If I'm looking for trading opportunities, I go shorter term. So I don't allow more time on short-term trading opportunities. If I'm looking to hold something for a day or two, I don't need to use September options. If I'm looking for a day or two, I'm better off either just trading the stock for the great liquidity or going into a short-term option to get that leverage and defined risk. Similarly with space, if I have a long-term thesis of bullishness in quantum computing stocks, I need to make sure I'm not going to get stopped out off of random behavior over the next week. So I have to set my stop at a level where it's only getting hit when I know I'm wrong, not when the market's trading randomly. If I set a stop right at my entry point, random walk, I can get right out. That doesn't mean it was an appropriate risk level. If I have to set that stop 20% below current market conditions to ensure that I'm not getting out for random behavior, well, then my sizing has to adjust accordingly. And that's where I can also say, well, if I'm worried about 20% in a day, it's a trading opportunity. If I'm worried about 20% over the next 2 weeks, then I'm looking for something that's got a long-term horizon. If I think there's a chance of going down 20% in the next 2 weeks, but there's not a chance of a 100% rally in the next 2 weeks, it's probably not a good time for me to get in. But otherwise, it's just all about trying to pair that time, that space with my thesis. We don't have the VIX at an extreme level, but it's not falling because we do still have fundamental overhangs. All right. And so they're there. They're just not really impacting the market that much. We always have to be aware of earnings dates on our positions. We just had Nvidia earnings. They were good. Market didn't really react. We had a minor pullback. Wasn't quite to the level of extreme euphoria that we saw from like an AMD or an Intel. Still good, but it's a $5 trillion company. It's hard to reward that with a 10% move and get it another $500 billion of market cap. So there we are with Nvidia. It just kind of says, well, it's already so rich, so highly valued that maybe there's not that much upside. At least that's the initial reaction until other things start to become more valuable. And then on a relative basis, it looks cheap. All right. We also have SpaceX with the IPO coming out in a few weeks, and that may have a big impact on the market. I think we got 3 weeks till that. That could have a big impact on the market as people try to navigate what's going on with SpaceX. How hot is the IPO market? Well, it's going to be hot for SpaceX. It's just a question of how hot, how big everybody, how much focus goes to the SpaceX IPO versus the other normal trading opportunities. All right, so we got some of the other normal stuff here. Market concentration already covered. Not calling a bottom on a dip. We're looking for signs of that bottoming process, and it looks like this is setting up a bull flag as opposed to a bear market, at least for now. But we got to stay flexible, and that's one of the benefits of a lot of the tools that we've got here at Tradespoon. Promise I'd show some charts here. The 10-year yield, as noted, down a little bit today, back below 4.6. So we peaked out on was that Monday, Tuesday? It's Friday. Yeah, so on Tuesday, we peaked out on the 10-year yield. And now that that's starting to come back down, it seems like the market's getting a little bit more comfortable, that we're not in a runaway bull yield market or bear bond market. A little less concern there. It's allowing the market to drift back higher. When we talk about crude, obviously one of the biggest things to watch when we're dealing with the Iran situation and evaluating how that's changing. It's up about 1% today. It's not anything particularly significant. The downside has stalled because we didn't make any other real progress. We have rumors of potential negotiation leading to concrete resolution, and then we have the sticking points, which seem like big ones. So delay. Every time we've had that rumor of getting close, we've had these big drops. This drop was a little bit less, but the pattern has been rumor of a deal and then rally back, rumor of a deal and then rally back, rumor of a deal and then rally back. Is that pattern going to continue, or is rumor actually going to lead to fact this time? My personal bias is probably going to be another rumor and another delay and another week or 2 or month or longer until this is fully resolved. And in the meanwhile, crude oil supplies are getting drawn down. And as those supplies get drawn down, the price has to go higher. And we're getting into peak demand for gasoline. It's usually targeted for the 4th of July. So we're getting close to that, a little over a month. We got Memorial Day this weekend, big gasoline demand weekend again, travel periods. This could be wild for oil if we don't get something moving with Iran in the near term. And my money is my personal bias is on, we probably won't have that resolution in the next few days or even week or two. But I've been surprised by the market before. It's just an odds game, right? I don't know specifically what's going to happen. I'm just expecting. And as I expect, I can start to set up my trade plan. Do I want to be long some energy stocks under this expectation? My viewpoint is probably. They've gotten a little bit of a dip in some cases, and those may be buying opportunities, much like the rest of the market has gone in and said that the semiconductor dip is a buying opportunity or the broad market dip is a buying opportunity. Speaking of that buying opportunity, when I look through some of the other indications of where this money flow is going into this recovery, we've got MMFI slightly above 50%. Now, MMFI, for those not familiar, is the number of stocks above their 50-day moving average, or sorry, percentage of stocks above their 50-day moving average. So it looks at a whole basket of them and says, hey, if it's above the 50-day moving average, that is an indication of general bullishness, below general bearishness. So when it's at 60%, generally we've got about 60% of stocks in that bullish case and 40% in the bearish case. And it's a slightly bullish market with more breadth. We were hitting new all-time highs without that breadth. We're getting more breadth now. And another indication of that is when we look at S&Ps, right now SPY is sitting near the highs, but the high was made on May 14th. When I look at the equal weighted S&P, so rather than being market cap weighted, this index is equal weighted, equal amount of money in each of those stocks in the S&P 500, it made new highs today. That's an indication that that the market is buying some smaller cap names. Right? They're not buying just the big boys, just the Mag 7, just those big stocks that are destined for greatness. We're getting more equal participation in this market and improving the breadth that has been limited in the recent past with that semiconductor rally. And speaking of semiconductors, they are bouncing back again today. They've been on a tear. SMH is the ETF that I look at for this. We had a tear since the beginning of April. Went from 400 to 600 nearly. So nearly 50% rally in just over a month. It's an incredible rally for a big, broad sector. It's destined to have some profit taking. And we did get that. Dipped down to the 20-day moving average, bounced off, ready to make a new high. Short-lived fall. Seemed like it could be more, but for now it's not. And so the bulls regaining control here, and they're pushing some of these stocks. Now they're not pushing Nvidia, but we look at stocks like Intel. Up another $3 today, up another 3%, pressing near the highs. We look at stocks like AMD, up another, how much today now? $20, 4%, new high. And then as I had mentioned, Nvidia, it still looks generally good. It's still a $5 trillion company, but it's down 1% today. They just had their earnings and people aren't quite ready to commit back to Nvidia. They didn't get quite the same reaction that you saw in stocks like Micron, AMD, and Intel. And so there's a rotation within semiconductors amidst a bull market. Finally, I always look at Bitcoin as an indication of other risk on barometers, and I'd like to touch on that real quick. So Bitcoin right now, we're not seeing heavy risk in there. Not a lot of money going into the crypto market. We are starting to see some money flow going into quantum computing due to the news this week that there was going to be $2 billion allocated to quantum computing by the United States. And stocks like IONQ or INFQ, there's a handful of these, up massively. INFQ at one point yesterday was up more than 40%. Today it's up another 20%. This is big money starting to move into this under the concept that this commitment of $2 billion is going to help fund all of the operational needs that they have. No need for secondary offerings. Now we got cash from the government instead. We can push, we can progress, we can make those massive changes needed, those massive infrastructure investments needed to develop quantum computing and accelerate maybe that AI story that much further if it comes to fruition, where somebody reaches that ultimate goal of quantum computing outperforming regular computing processes these days. All right, so amidst all of this, I'm looking around and I'm thinking to myself, how am I going to find the right opportunities for me? Well, if I'm looking for an investment thesis, I have to dig into some of the fundamentals. That might be the quantum computing stocks and looking at long-term call spreads. Touched on that during the trading room yesterday. The concept that, I could buy this and we may get a dip because there's an initial reaction of buy the rumor, sell the fact, or take some profits here. Overall, I think the long-term investor is going to buy and hold. May mean that in a stock like IONQ, we still dip down to 55 or 58 at some point. But are we really going to dip back below 45? Doesn't seem likely. And is there that chance that we start reaching levels that we've seen at the highs, 85 or even higher? I mean, for me, I would think, yeah, that seems like a reasonable expectation. So a long-term call vertical can be a way to express that view. Buying a $70 call and selling a $100 or $120 call to help finance it, knowing that, implied volatility in these names is still very high. Options are very expensive. And I'd probably be out by 100 anyway. So I might as well put on a position that tells me I need to act at $100. It helps me with my psychological trading. I can say, if I've got a call vertical and we're starting to reach the upper end of my spread, I need to act. If I want to have that unlimited upside in case IONQ goes to $1,000 a share, and I actually can hold through that after buying a $70 or $100 call, sure, great. But not many can have that stick to itiveness of saying, I'm in on the $100 calls for $4 and I'm not selling them until they reach $400 a contract. Money in the pocket is always attractive. And frankly, that's an outlier move that is unlikely to happen. Now, if it does, the person that does so is greatly rewarded. But realistically, not many of us have that mentality. So structuring the trade to match my thesis, to match my trading style is crucial. And that's why I like to use call verticals even on anything on the long haul, or some sort of spread on the long haul, buying a long-term call and then financing it as we get rallies, short-term profit-taking levels, selling a shorter-term call, like a June 85. I'm not sure we're going to get to a new all-time high in the next month. If we repeat the semiconductor type move, 85 will be left in the dust. So that's my risk. But if I'm looking to sell it at 85 anyway, I can always buy right my position or sell out a shorter term call against a long-term bull position. Then the other idea is to just go through the Tradespoon tools. We've got things like the forecast toolbox that give me an indication of what I should expect for today. And if I look at S&P, it didn't look like there was anything projected to be particularly dynamic today. Or I look at QQQ and I say, well, today looked like maybe another blase day. Is there opportunity here in this market when I'm seeing sideways behavior projected for the near term? There is. It just may not be in the big sector trades. So I switch over and I look at things like active trader. If I'm looking for something for a day trade today, quick scalp, I can look at a stock like Delta Airlines, which already had the entry and the exit. So on the open this morning, the stock opened at 76.03, dipped down to 75.51. I love the active trader for those that are looking to trade stock because it helps give an entry point for half of a position and then an entry point for the remaining half, a stop loss, and a target price. If I set a buy mode at 75.65 because the market's not down more than 0.5%, if we had a bear market going this morning, it would be less aggressive. We didn't have a bear market going, buy in on that little dip, looking to sell at 76.41. Today's high, within that first hour, we had 76.95. If I use this tool this morning to buy stock and sell it, I made a quick 80 cents per share. On 100 shares, that's a quick $80 in a matter of minutes. And my risk was $80. So if I'm looking to risk, whatever I was willing to risk, I've already profited. So if my risk is $300, I'm buying a few hundred more shares, making $300 already, and then moving on to the next trade and saying, all right, well, that one's done. What could be next? And I can go down to the next on the list, and it's eBay. The eBay's entry point was 117.13. Today's low is 117.57. We haven't hit it yet, but I can wait and see if we can get that dip. And if we start getting into the late afternoon, maybe I don't look to buy this trade for a day trade or take the weekend risk. But over the next hour or so, if we get a little dip, I know my buying zone and I know my profit target and I know my stop loss, and it's well defined. Or Kimberly Clark, entry at 98.73. This morning we got down to 98.80. We got within the parameters here, plus or minus as a range entry. So technically, if I didn't go completely right on the number, might have been able to get in. The exit was 99.72. Today's high is 99.75. So you can see how well this pinpoints those moves on quick durations, especially at the beginning of the day. Love Active Trader for this. For those that are looking for day trade scalps early in the morning, can basically trade the opening print and then set it and forget it for the rest of the day. Maybe already be out, as in the case with Delta, KMB, if already in, already out. But I can always set my stop loss with stock and then move on. This is a spot where I normally don't use options, though. If I'm looking for a day trade, these target prices, they don't generally get well leveraged with an options trade. So it's more of a stock trading philosophy. I will note that today we had no bears. Nothing that looked good probability-wise for a bearish move. When I'm starting the week, I look at the weekly trader names. This is always my starting point for the week, and I look at them throughout the week to see how things are going, right? In the case of EOG, we had an entry parameter at 140.26. I don't think we got there. Oh, no, we did. So we got in there. We were there at the morning on Monday, and we peaked out above 143. So again, profitable trade. We had the entry, we had the exit, we had the stop. We haven't hit the stop. We already hit the target. Everything's rosy here, right? LRCX got below the stop, and it got below the stop quickly. So the market started off at 280, started off below the first two entry points, and stopped out almost immediately. So unfortunately, that one started off too low. It started right near the stop loss. Might have needed some parameter adjustments on the entry. May have been a little dicey, but the risk was defined. Or NDAQ, an entry point at 91. He started off right off near that low, ended up hitting just below it right on the open on May 20th. But if I go back to May 18th, we got below that first entry point low, and we peaked out above the highs. So if I started on Monday and got out and didn't wait until later in the week, I already hit my profit. Re-engaging, question mark, right? The market was starting to fall here. May have been able to get back in, but I would have been stopped out. Oftentimes, it's best to just say, all right, with that weekly power trader name, I already got my win. Get in on the open on May 18th. Take the exit on May, where did we hit the high? Yeah, I guess it was on May 18th in that first hour. Hit the entry, hit the exit, turned out to be more aggressive, which is great. Now, as I'm moving on, the other thing that I like to use with the Tradespoon tools is, of course, the forecast toolbox. Now, this is the engine. This is the brain behind it all. We get the filters down in the active trader list, the weekly trader list. But one of the things that I think a lot of people can and should take advantage of is this company screener. Now, I can go through any of these filters, but my preferred one is this stocks and ETFs with a model grade A or B. These are great opportunities for me to identify stocks today. And then I have to set my own parameters, of course. I don't get that extra guidance, but I can start off and look through and say, if I'm looking to trade something that's very high risk, more high beta, big tech, I can look at a Cisco, or I can look at cybersecurity with Fortinet, or I can look at IBM. If I want to avoid all of that and say, I got to just find something that's a little higher predictability, I start filtering down and I look through. And one name that caught my eye in particular, and I haven't looked at all of these, but I've noticed this a couple of times, was Henry Schein. And I first started looking at this on Tuesday evening because it was coming up then. So I'm going to address that one along with this. When I look at a Cisco on the list, I say, okay, how bullish does it look? It starts bullish, maybe a plateau, and then bullish again. Depending upon my time horizon, I can structure a trade around this. It's got a high probability of success. Probability of staying within the range is 89% today. That's very high. Probability of getting the direction right, 2/3. That's high. That gives me an edge over the market. Projected close today is $122. If I can get in near the lows of the range, I can expect a potential for a 2% return in one day and a 4% if I can actually achieve the high. And if I can hold it for a couple of days before it starts to plateau and maybe exit on Wednesday of next week, I could be looking at a 15% return on the stock. And that sets up some of these options trades. When I look at Cisco, I say, okay, Cisco, an option for next week. If I want to go risky, I can take a short-term weekly option, buy a 120 call for next week for $2.30. Forecast Toolbox says we could peak out at 135. That's a lot of leverage, a lot of potential reward there. Go to 135, that call's worth $15. That's a high risk, lower probability of success, but the model likes it. When the model likes it, I tend to think about getting a little more aggressive. Similar story with Fortinet, right? Fortinet, a very stable, casual rally, we'll almost call it, like 2% a day, every day for the next 2 weeks. That looks great to me. 72% probability, 48% probability of change, a little lower model grade. That can reduce my confidence when I see that that model isn't as confident here as it is in Cisco. Nonetheless, I can still make a trade decision on it based upon this expected bullish behavior. It can be similar. I can look at a call. It's a lower return, so it's going to be a lower vector, so a lower return on a call position. I could look at a call vertical. I could look at a put credit spread. There's many ways to trade these opportunities. When I look at IBM, this is the type of stock that I say, wow, the model says choppy. So, all right, even though today's probability is high, that move yesterday really kind of broke things down a little bit. We got a great model grade for today. But I see a move up, followed by move down, followed by recovery. That makes this a little bit tougher for me to trade. And so it can help me identify those names that aren't necessarily as predictable. Even though it may be exciting, it's not predictable. And so I want to move away from stocks like that and focus on those predictable moves. And again, if I want to get away from all of that tech noise and think about something else, I like looking at Henry Schein. Got a model grade A, similar probability of staying in the range, similar probability of the change as we saw in Cisco, but it's not subject to a lot of the tech focus right now. And it's got a great looking return. 7% in Henry Schein is a good number. When I'm looking for a correlation here, Cisco on a day-to-day basis is about a 2% move normally. It's low implied volatility relative to recent. Henry Schein's implied volatility is lower. So it's expecting less moves, less movement. Now, it's not going to give me the same dynamic potential return, but it gets me away from some of that other risk. And so I could look at a 75 call expiring in June for about $2 and know that the model's projecting it to get up as high as 80 in the next 2 weeks. That should make that call worth at least $5, if not $6, or even maybe $7. It gives me an opportunity here to generate some big returns. And if that's not quite right for me, I can always look at a call vertical, and I can get better execution with a call vertical, especially with wide markets. I just have to start below the midpoint, because the midpoint on this says, the value of this call vertical looks to be around $1.55. I have this other tool that they charge money for, but it says that this model value should be closer to $1.30. So when I've got illiquid markets, I don't want to just start at the midpoint. I want to start near, maybe halfway between the midpoint and the bid, and then start drifting up my market to see if I can get filled. And if I can't get filled, I can't get filled. That's okay. Not great liquidity. I just go back to the stock and say, this is a stock trade, and it's a good stock trade because I can buy in for 73, 74. I can use some of these parameters for expected lows, move a little bit below them as a stopping point. I can check my technical analysis and say, all right, I think that this stock should hold above 71. That's a good stopping point. And my target point is driven more by the close or a little bit less aggressive than these highs. I don't want to try to capture the entirety of the move. I'm unlikely to do that. But if I can capture the midpoint of the move on the day that I want to exit, I feel pretty good. So I may target 77. If I'm targeting 77, I don't see any major resistance to that point. I'm risking 280 to make 320. A little bit better than equal size risk and reward, a little bit better than equal size probability of up versus down, and that gives me an edge. And these are some of the benefits that I see with the strategy elements that we've got here with Tradespoon. Right, folks, I just wanted to touch on a little bit of that stuff with you guys today. Thank you again for everybody for joining and talking through this stuff, or listening to me talk through this stuff with the active trader, weekly trade, or general macro conditions, and some of the tools that we can use with Tradespoon to help trade smarter. And that's the ultimate goal. Find an edge in the market and trade it the right way, and look for some ways to generate some better returns in the market. And I think that's the ultimate goal for everyone. Thanks again, everyone.